You're about to hear my conversation with Matt Moody, portfolio manager and head of Mackenzie's Ivy Boutique. Today, we are going to talk about how Matt and the team have been navigating the volatile investment market in 2025. I'm also going to glean his insights on the retirement of Warren Buffett at Berkshire Hathaway, and finally, a conversation about how Matt thinks about talent recruitment for his team. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, head of portfolio construction in Mackenzie Private Wealth. Today, I'm joined by Matt Moody, portfolio manager and head of our Ivy Boutique. Matt, welcome to the podcast.
Thanks, Rajan. Excited to be here.
Excellent. I'm going to hop right into the questions. My first question, Matt, 2025 has been a very volatile time so far for any equity investor. I'm just curious, from your perspective, how have you navigated this environment, given that it's really been driven by the on-again, off-again tariff policies coming out of the United States?
Sure. And of course, it has obviously been a pretty interesting start to the year, to put it mildly. And I'll get into how the specifics of kind of what we did on Ivy in navigating this environment. But I'll start with the basic principle that we always root our activity in, that we really don't know what's going to happen, right? I know that's maybe not great podcast material to say off the bat that we don't know, but that really helps us zoom out and focus on what matters from a long-term perspective, and that's the quality of the businesses we own, the price we're being asked to pay for them, and has anything materially changed in this turmoil of March, April that would cause us to change our views on that. So when Liberation Day came out, obviously a lot of things started to happen all at once. But really, what the most important thing is, market started to drop, and what that does for us. So when we look at the companies that we own and that we would like to own, we look at them all through the lens of our sort of 10-year expected return. There's nothing magical about the 10-year time period. It could be 7 or 11, but really it's this idea that we want to capture and somewhat have an idea of the long-term prospects for a business, including the impact of an economic downturn, right? So within a 10-year period, probably there will be some sort of downturn. We don't know the cause, but that forces us to kind of take that future hypothetical downturn into account when we're considering our investments. So volatility is our friend if you use that as your sort of starting principle, because when markets are moving around up or down, then really what happens is our 10-year expected returns can get materially better or materially worse. There can be more disparity between what we own if some things hold up much better than others. And so really, as long as nothing has changed in the long-term prospects, we simply get opportunities to buy and sell things. And that's what we did. And it was, for us, a very active time. It was probably the most active we've been with Ivy Foreign Equity, at least since COVID, right? So we probably bought or sold, call it 700-800 basis points, 7 or 8% of the fund in each direction in the first couple weeks of April. And that for us is pretty intense activity, because normally we have pretty low turnover in the Ivy funds, more in the sort of 20%-ish per year range. So a lot of activity, a couple new names brought in, a couple other ones on their way out, and some reallocation within the fund. And how we decide on exactly what we're going to buy and how we're going to reallocate, again, back to this idea that we're not out there predicting what's going to happen with tariffs. Are they going up? Are they going down? Are they going to stick? Are they not? We really try to look for businesses, first of all, where we think the prospects have not materially been altered, and where that expected return is very attractive. And so that's where we will sort of allocate capital. It will be away from ones that have maybe held up really well, or in some cases have actually increased in price, which really brings down that forward prospective return, and we allocate out of those names. And then we have that sort of third bucket of companies, and we do own a few of them, where they are impacted by tariffs. I'll use a simple example of Texas Instruments, which we've held for a long time. Semiconductor maker based in the United States, a lot of flow of product between the United States and China in both directions. Their end markets, auto is a big one, general industry. So a lot of things going on from a tariff perspective that could impact Texas Instruments. And so what that means for us is, okay, the environment has changed for this business. And so, really it is kind of widen this cone of uncertainty around our long-term assumptions. So we're going to tread carefully, right? It's not that we're not going to buy any of it, but we're simply going to require a higher expected return for companies that are in the crosshairs. But luckily for us, I mean, the Ivy style typically has steered us to areas that are less impacted directly by tariffs. Who knows the second and third order impacts? But we were in pretty good shape positioning wise heading into this period.
Okay, excellent. Matt, just a quick follow up question based upon how you're managing the portfolio, because I feel like you really shed some important light on the investment process and how it's how you operate in times of volatility. I'm just curious when it comes to engaging with management, because I know you and the team get to know the management team and the companies really, really well. During these periods of volatility, are you more likely or less likely to speak to management, or does it have no impact at all?
Yeah, I think it has an impact on those companies again that might be more in the crosshairs, where we would want to reach out and make sure we're crossing our T's and dotting our I's on what this potential tariff impact could be. But we're happy. I mean, a general rule for us, longstanding rule on the team, is we just love those companies where contact with management once a year is plenty, right? So it's a sign that things won't change for them on a quarterly basis too much. That's going to move the needle in what this business can achieve in the long term. And so if I look like a company like Colgate, to take an example, right? They may have some tariff impact on the business, but by and large, they're economically resilient. We know what they do. We have an idea of how they're going to react. And so we have a number of names like that through the portfolio where that sort of constant interaction with management is not really required. But meeting with management and talking to management is really helpful in helping us to find those businesses that we want to be owning in times of stress, right? We want to own those types of businesses where we have full faith that they are going to react and adapt way better than their competitors are going to do. They're going to emerge on the other side stronger. And so in that situation, we don't really need to be on top of them asking how things are going.
Okay, excellent. I'm going to transition to another current news item, but very different. Essentially the retirement of Warren Buffett at Berkshire Hathaway, where he's stepping aside and his chief lieutenant will be stepping in as CEO. Before I get into thoughts on Berkshire Hathaway, I want to get your thoughts on Warren Buffett. You're leading the Ivy Boutique, big focus on quality. I'm sure had a pretty significant influence on you and how you invest, but would love to hear it in your words.
Sure. I mean, obviously, he's been a huge influence on me and others on the team and investors everywhere. Right? It's this multi-decade career of not just great investing, but great communicating, and it's really unusual to see both of those together. Right? His ability to communicate investment concepts or theses about individual companies or big themes, distill it to the essence of what it is, and explain it to people in ways that they can understand, is rare. And it was kind of a gift to aspiring and practicing investors. Yeah, as cliche as it is to say, that Buffett has been an influence, he definitely has been. It is sad to see him retire, the end of a very long era. But look, I mean, we knew this day was going to come. It shouldn't be shocking that someone in their mid 90s is going to retire. But yeah, it does mark an upcoming end to a very long and instructive career.
Of course, and he has been a great investor and a great communicator. I know you've been a longtime holder of Berkshire Hathaway. What does it mean for your thesis and how you think about the actual stock?
Well, I mean, obviously, having Buffett on board is clearly better than not having Buffett. So from that point of view, it's a negative. But we knew this day would come. right? Back to this idea that I explained earlier, that we have this 10-year investment thesis for the companies that we hold. Obviously, having Buffett's involvement as core to that 10-year thesis would not have been the greatest idea, actuarially speaking. That was baked in to our view of the business. That, look, this is going to happen. So are we comfortable with a Buffettless Berkshire? And we are, because if you take Buffett out, what you are left with is the actual machine, which is a diversified collection of good businesses, broadly diversified across industries, with a really strong kind of insurance arm that provides the float to investing in those businesses, investing in stocks. And sitting on top of that machine, you have this culture of prudent capital allocation, right? Patient, disciplined, long-term thinking, countercyclical in how they think and how they act. Those are traits that we admire, and those are traits that are rare. And I think obviously Buffett embodied those traits, but in planning for the succession of Buffett, obviously they are selecting people who are aligned with that ethos and have those cultural traits. And so we would expect that sort of prudent, countercyclical capital allocation, strong balance sheet type thinking to continue. And the succession has been flagged. We were aware, obviously, as everybody was, who would be taking the reins. And look, I mean, we're not expecting Berkshire to be the Berkshire of 20 to 30 years ago. That wouldn't be realistic, but it doesn't have to be a solid investment. And so it doesn't really change our thesis, but we are obviously watching how Berkshire beyond Buffett will behave and act. And we reserve the right to change our mind, right? So we're in a watch and wait and learn mode, but it remains a core holding for us.
That's really great. Thank you for those insights, Matt. I am curious because you talked about expectations, you talked about how you invest, countercyclical, specific to Berkshire. But I'm thinking about the next question from the perspective of those who are listening. How would they expect, or how should they expect, the Ivy style to work? Is this a style that works when growth is in vogue and growth stocks are shooting the lights out, or would it be at another time?
It's very much the latter. So the Ivy style, if you go back again, we started back in 1992, and we've been following more or less the same philosophy since then. And it has led to a very consistent and predictable, I would say, performance profile. And that is that, when markets are hot, when there's a lot of risk out there, people are excited, there's lots of green on the Bloomberg, that kind of thing. That's typically the environment where the Ivy funds are not going to fully keep up, right? And conversely, when markets become volatile and we see downturns, particularly when they're associated with and coincident with sort of economic recessions or fears of recession, that's when you really see the Ivy funds hold up pretty well. And that's happened, consistently over time, even though the exact causes of all those individual downturns have been different, right? And again, we don't know that these downturns are coming. And so the performance of the funds in those weak periods is not because we somehow, presciently figure out that there's going to be something bad happen and we react faster than others, because that's not really what we do. It's really because we're being careful when times are good, right? We want to have, sort of like Berkshire, this sort of counter-cyclical way of thinking where we always factor in the potential for times to get rough, even when the seas seem calm. And so again, the preference for economically resilient businesses with strong balance sheets, trying not to overextend ourselves in what we're willing to pay for these businesses. This sort of conservative, slow and steady approach can lead to the funds lagging in long, strong bull markets, but holding up well when times get rough. We saw that in April. We saw it, frankly, in any major drawdown over the past couple of decades. So that's really what our long-standing clients have come to expect from us, and that's what prospective new clients should expect from us. Right? This is not a style that's going to perform every year in all environments. It performs well over time in a careful, risk-adjusted way. But again, risk on, probably Ivy not going to leading the charge. Risk off, that's where you should see us start to provide some value.
Matt, I'm going to play some words back to you. You used the word careful. You use the word conservative. You use the words slow and steady. It leaves me with the impression that you get really excited by the boring. So perhaps you have a boring stock in the portfolio that you're really excited about. I will leave it to you and your imagination which one you would love to share, but it would be really interesting to hear a story about one of these companies, and maybe give us one that most of us haven't heard of.
Sure, I can probably give a couple, and yeah, I'll skate past the implications that I'm boring. So that thanks for that. But yeah, but look, we do love boring companies, and this should be a sort of sleep at night fun to have in your client's portfolio. And we're there to be boring, and to keep your clients, frankly, or keep our clients invested in tough times. And so we wear that sort of boring badge with pride. So I'll quickly go through maybe a couple stocks. One is called Compass Group, and these are both the both ones that I'll talk about are in our top 10. So Compass, not very well known, but it is kind of pervasive in society. They employ, over 500,000 employees, and what they do is they are the world's largest catering company. So they serve meals. This could be at company cafeterias, could be at ball games, could be at your hospital or at the high school or university. Anywhere where large numbers of people have to be fed on a regular basis, that's where you'll find Compass active. And that's where you will find them, frankly, performing and out executing all other companies that do this type of work. So it's a sort of boring, unchanging business model, right? They have identified the few levers that they can pull to really succeed in this world, and that is, how do you win customers? How do you retain them? How do you buy food? And how do you manage your employees? And on those measures, they set out to be just a little bit better than their competitors and a little bit better than they were in the prior year. And this is sort of a game of inches where margins are thin. But if you can do those things well and consistently well, as Compass has managed to do, then you can have some pretty fantastic results. But again, fantastic is not, we're not talking, tech company growing 50% per year, but this is good, steady, economically resilient growth with a strong balance sheet, a business model that is not at risk of disruption in the sort of near to midterm. It's a sleep at night kind of company, and the fact that it is boring is really exciting to us. Maybe another one that goes along with that is also in our top 10. It's called Halma, and this is a UK based company, but they operate globally. And Halma is really it's a collection of 50 or so operating companies. So it's pretty decentralized in what they do. And these companies are doing a wide range of things, really kind of, technology products that do things like monitoring corrosion in water pipes or making industrial interlocks that help workers from getting hurt on the job, or fire detection products that go in buildings, these types of things. But they're really into like safety and health, and those kinds of things that are often regulated. So customers have to buy or have to continue to keep these things up to snuff, and where there's sort of a long-term runway for growth. So a bunch of decentralized operating companies doing a lot of different things. They're resilient. They have a strong balance sheet. And important for us, they have a very strong management culture. This is a company that has gotten that balance between centralization and decentralization pretty much just about right, where they give a lot of leeway to those operating companies to do what they do, and the center is there not to direct them but to support them. Right? They invest in their growth. They help them develop their people. They encourage them to innovate, and they give them capital when they need it. But other than that, they sort of leave them alone. And so what Halma has created over time is just this machine that acquires businesses, invests in their growth, and keeps the sort of machine sort of operating smoothly, producing, call it double digit growth pretty consistently over many years. And so this is, not a company that's well known. It doesn't really change. There's not kind of an exciting story to tell, but that's exactly what we're looking for, right? That resilient growth that we have some confidence will persist, not for 2025 and 2026, but out to 2035, right? Because it's supported by a model that makes sense, and a management culture that understands what makes the company great and continues to invest in that.
Matt, those are two excellent examples, which leads me to my final question. Now, you're clearly a very passionate quality investor. I can't confirm this, but I'm under the impression your first word may have been quality. And my last question is, so in that spirit, is the Ivy team all about you? Is this a personality-driven boutique?
Well, definitely not, is the unsurprising answer. I think one of the key characteristics of Ivy is that it isn't a lead manager focused style. And this has been true for many years. It was true under the prior two team leads as well, Paul Musson and Jerry Javasky. And in my mind, this is what makes it sustainable, right? Because it doesn't matter so much who is the lead manager. What matters is that Ivy as an investment philosophy is being applied consistently by like minded people. So, in the case of Ivy Foreign Equity and Ivy Global Balanced, I am a portfolio manager. I'm the lead manager on those funds, but I don't have a team of people feeding ideas up to me and I make all the calls. Like, it's pretty decentralized. So I'm one of four PMs on those funds. So we also have Adam Gofton, Jason Miller, Hussein Sunderji. They have really important roles in the success of those funds, as well as Colin Cameron, an analyst on our team. And similarly for Ivy Canadian and Ivy Canadian Balance, there we have the team James Morrison, Marlena Zabielska, Sid Dilawari. So they work pretty cohesively as a team to apply the Ivy style to the Canadian market. So my chief role is really to get the right people on the team, embed the Ivy discipline, make sure we're all rowing in the same direction, and make sure we're functioning well as a team. And it's this way of operating where it is about the style and not about the people, or about sort of the person at the head of the team, is, I think, what has really led to that consistency and performance profile that I mentioned earlier. It's been true across funds and it's been true across time. And so we want to really make sure that that remains true for many years to come.
That's great detail on the team. Very much appreciated, Matt. I wanted to really thank you for joining the podcast, and I'm already looking forward to the next time that we'll have you on as a guest.
Thanks a lot, Raj, and always enjoy talking to you.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.